All right, good morning, everyone, and welcome back for our 11th episode of Equity Explorer. I'm Karina, a global equity investment specialist at Fairtree, and I'll be moderating today's discussion with Shark. So, just to give you guys some insights on Equity Explorer, it was designed as sort of a teach in on key themes in equity markets, basically just trying to offer some deeper insights into different industries, companies, and trends that are shaping global investments. So, our goal is to give you the tools to better understand the forces driving markets and to highlight potential opportunities. However, please do note that this is not financial advice, nor does it represent a deep dive into our portfolios. We're happy to organize that with you guys if you are interested. And with that, I'm really excited to introduce today's discussion, where we'll be unpacking sort of the evolving Chinese internet and e-commerce landscape with a deep dive into some of the most influential players in the space. Please feel free to send through any questions during the presentation, and we'll try to answer as many as possible at the end. With that, I'd like to introduce Jacques and let him take us through the content for today. Over to you, Jacques.
Thank you, Karina, and welcome to everyone on the call, and thank you for taking the time to join us this morning. As Karina mentioned, we'll go through the Chinese big e-commerce tech companies. First section is going to start off with a brief touch on the macro and the Chinese consumer. I'll have a brief look at the industry players and the trends and how that have developed and where we are now, and then we'll talk you guys through the different business models and end with Q&A. So maybe just firstly on the Chinese economy, we've seen continued strong overall GDP growth. If you look at the chart on the left, but and that's been driven by export, as you can see from the chart on the right, despite the ongoing geopolitical talks and the tariffs from the US. But we can see our real estate have stalled compared to our GDP has grown. So the chart on the left shows our property prices have changed year over year, and we can see how the property bubble burst in 2022 with prices decreasing dramatically in both tier 1, 2, and 3 cities. We've seen a little bit of a slowing in the decline in the property prices, especially in tier 1 cities, but they are still decreasing nonetheless. And you can see what an impact this has had on consumer confidence with that light gray line absolutely falling off a cliff as property prices have continued to decrease. And this is because a significant portion of Chinese consumer wealth is invested into property, somewhere between 60 to 70%, and we know in the US it's closer to 30%. So we can see how that's impacted consumer confidence from that negative wealth effect. And then the chart on the right shows housing starts and how that has also decreased dramatically with the bursting of the bubble. But it's important to remember that it's matched previous cycles that we've seen in other parts of the world. So with that negative wealth effect and the drop in consumer confidence, consumer household expenditure relative to disposable incomes have continued to decrease. This chart is from 1995 to date. And you can see how that has decreased, continuing to decrease as households save more. And looking at household consumption expenditure as a percentage of GDP, we can also see that as a percentage term, it's continued to decrease. And after increasing from 2010s, it's stalled since then. So household consumption expenditure is still growing, but as a portion of GDP, it's stalled. And this has meant that your savings rate has increased quite dramatically. Consumers are not investing in property anymore, so they're sitting with their cash on the sidelines. And you can see how household savings rates have increased again from 1995 and hasn't really stopped, and significantly above other parts of the world where they also had property bubbles. And just looking at the savings deposits at the moment relative to COVID, we can see the dramatic amount of cash that's been saved and the increasing in savings deposits that's been built up. And we can see what happened to the rest of the world, where the US kind of also had this build-up of savings with their stimulus, but then kind of to spend that cash and consume. But we haven't seen that from Chinese consumers. So the government has, however, stepped in to try and promote consumption with their stimulus programs, specifically the ones they announced in 2024 with their trade-in programs. And we can see how that has come through in the increase in home appliances and communication equipment and how that has benefited. But as those trading programs have kind of stalled, we can see how the sales have decreased back to trend line after this big increase and that kind of high base effect. So then just quickly looking at the industry overall to simplistically set the scene, we think about it in two different types of business models. You've got 3P and you've got 1P. So 1P means that the platform or the retailer buys the inventory. So it's more capital intensive, but you have more control over the quality of the product, and your markup is also higher to compensate you for that increased capital intensity. And then on the other side of the scale, you've got 3P, where suppliers list their products on the platform and you earn a take rate or a commission on the sale, but you have less control over the quality of the product, but it also means you're less capital intensive. And this is important to remember when we're looking at the numbers and the different business models. So then just looking at the China e-commerce landscape at a glance and the major players, we've got Alibaba, JD.com, Pinduoduo, and Douyin, which is owned by ByteDance, which is the Chinese equivalent of TikTok. And this is quite a busy slide, but what I wanted to highlight is the active shoppers on the different platforms. We can see that Alibaba has about 900 million active buyers on their platform. JD.com has 600, Pinduoduo 900, and Douyin, according to estimates, is around 500 to 600 million. So Douyin has taken a lot of market share in a very quick space of time with aggressive marketing and subsidies for the products on their platform to attract users to their platform. Looking at the ticket sizes, this is also important when we're looking at how these guys differentiate from each other and how they interact with the platform. The ticket sizes on JD.com is significantly bigger than the rest, and this is because more than half of JD.com's sales is from electronics and home appliances. So your ticket item is a lot bigger. And of course, that also means that your frequency of shopping is a lot less on their platform. Compare that to something like a Pinduoduo, where your frequency of orders placed is a lot higher because you're selling more value for money products. So you're buying products more frequently, but your ticket size is small. And Alibaba plays somewhere in between those two. So then looking at the gross merchandise value per platform, we can see the strong growth in GMV over the past 10 years. Alibaba's grown at a compound annual growth rate of more than 10%. JD.com's grown by more than 15%, and we can see how explosive Pinduoduo's growth has been through their algorithm and how successful that was, and I'll unpack that in a bit. But since 2022, GMV growth has essentially stalled, and that again gets back to the property bubble that burst in 2022, consumer confidence dropping. So you haven't really seen an increase in GMV for these two platforms. They've of course also given up relative share to Pinduoduo and ByteDance. But the active buyers on their platform has continued to grow. So that essentially means that the average spend per user on Alibaba and JD.com's platform has decreased in the ticket size and the amount that they're spending. We can see how Pinduoduo has continued to grow, but not as fast as that explosive growth in the beginning when they launched in 2016. And Tencent just continues to build out their ecosystem, and this refers to their monthly active users, and you can see how strong that growth has been. So in terms of the competitive financials, again, GMV for Alibaba and JD.com has essentially stalled since 2022, but that doesn't necessarily mean that your overall top line growth slows down or stalls, because Alibaba was able to better monetize their GMV, so your revenue or your take rate is higher. And they've of course also got the cloud business that they that they're building out that's growing very, very fast. And similar with the rest. So Pinduoduo continues to grow very strong. Temu continues to take market share offshore. And we can see how strong the growth from ByteDance has been. And they've just been very, very successful in taking share from the incumbents. And it's also been profitable share. It's not like they have been very loss-making. Estimates of the last 3 years kind of shows their profit at 350 billion renminbi for 2025. So now looking at the different business models and delving into each one of them, we're going to start off with Alibaba. And I mentioned that Alibaba has a gross merchandise value, so the amount of value that's sold on the platform of more than $1 trillion. But what does that mean? So that means that if Alibaba was a country, it would be equal to the size of Poland and thus the 20th biggest in the world. So that just gives you an idea of the scale of these platforms and how big these businesses are. The Chinese market is the biggest e-commerce market in the world. More than half of the world's transactions happens in China. So that just kind of sets the scenes of just how enormous these businesses are. And then looking at the business breakdown for Alibaba. So Alibaba has four main pillars in their business and their strategy. And their mission is to make business easy to do anywhere. So they've got various different businesses and operations, platforms, logistics to help small businesses manage the entire process from selling, marketing, procurement, logistics, cloud services around that, finance, and more. So just a very big platform for other small businesses to do business off. Alibaba was founded in 1999 as Alibaba.com or 1688, which was their wholesale business. And it's a leading integrated domestic wholesale marketplace. It's known as the product source for Chinese e-commerce, bringing together wholesale suppliers and offering goods at competitive prices for various industries. Then in 2003, they founded Taobao. And Taobao means search for treasures. So this is a consumer-to-consumer platform, consumers selling to other consumers on that platform, and again, providing a various assortments of goods and services. Tmall was founded in 2008, and Tmall is a business-to-consumer platform, so businesses selling to other consumers via Alibaba's platform, providing them with, again, high quality and value for money products. And then in here we can see LME and the Taobao Instant Commerce. So this is the quick commerce business, same day delivery or quick delivery business that also forms part of the core Chinese e-commerce business. Then on the international commerce side, AliExpress, that was founded in 2010. It's a global retail e-commerce platform. So this enables consumers to buy directly from manufacturers around the world on their platform. Lazada was founded in 2012. Again, all of these are e-commerce platforms, but they focus predominantly on Southeast Asia, Malaysia, the Philippines, Singapore, Thailand. Daraz was founded in 2015, also Southeast Asia, but more focused on Pakistan, Bangladesh, Sri Lanka. And Trendyol is the Turkish business. And of course, the wholesale business forms part of the international business as well. Then Alibaba Cloud, which is getting a lot of attention at the moment, and the build out of Alibaba Cloud. And that's kind of why the share prices has done so well, because the market is very excited about the cloud business. The cloud business was started in 2009, and it's really a leading cloud computing and now AI business. So they're the largest provider of public cloud services in China. They offer the full stack of services based on a three-tiered architecture of infrastructure as a service, a platform as a service, but then also a model as a service to customers around the world. And then all the other businesses they group into other, which is really the logistics, Alibaba Health, Freshippo, the maps, all the other businesses that they're involved in is they group into other. But these are really the three key segments to think about. So in terms of the quarterly growth in the businesses, wanted to highlight the strong growth that we've seen from cloud. So the cloud growth is really accelerated. It was growing in the high single digit to low teens just over a year ago. Now they're growing at 34%. So the cloud business is really doing very well. The China e-commerce business has also picked up its growth. They've had a big push into quick commerce, invested quite a bit of money there at the moment, and we'll see that effect on the next slide. But that's propped up that business, so that continues to grow at double-digit type growth. And then the international business again also continuing to grow very strongly in the high teens, low 20s as they kind of build out the international business and the international offering. And then all the other businesses, as I mentioned, is classified in here. That this drop at the end of the first quarter, and that was due to the sale of Sun Art and InTime. The management have taken a strategy to clean up the portfolio, divest non-core assets, and we can see that happening in all others. And then in terms of margin and margin progression, the e-commerce business, the competition in that business, first of all, materially stepped up, but then stepped up with the players like ByteDance, but then also from players like JD.com entering the food delivery business. So as I mentioned, Alibaba had to give aggressive subsidies to their suppliers and subsidies or incentives to consumers to pull them to the platform. That has of course come at quite a big cost. This business used to do close to 40% margins, and that's now down to 8% as they defend market share and trying to grow. But that was really the profit center of the business. Cloud intelligence. This business is at the moment earning high single digit type returns, excuse me. And the market's been slightly disappointed about this margin because they've thought they should scale this margin quicker. If we look at some of the hyperscalers in the US, we've got Google Cloud, Azure, and Microsoft earning high 20s to low 30 type margins. So this margin does look quite a bit lower, and the management team strategy at the moment in this business is to build out the revenue of this business and not really focusing on profitability for the time being. At the moment, it's all about market share and then growing the business, and then monetization will follow at a later stage. But they've also cautioned that we shouldn't think about the margin profile in this business yet to be similar to the US peers. It seems like the profit model in China is going to be slightly different, where they don't really want to monetize the cloud business through subscription, but it will rather be monetized through ads, which means that it could be structurally lower over time. And then the international commerce business, quite positive to see that business as it continues to grow and continues to scale, is now at break even from being quite loss-making just a few quarters ago. But very nice to see that business getting to break even as they continue to scale, and then all others again sitting at low single-digit type margins. So just in terms of Alibaba Cloud, we're looking at the cloud business. We can see that they've got the highest market share within the AI cloud. But ByteDance has become an increasingly larger competitor through aggressive pricing. They've taken 15% market share in cloud, but Alibaba continues to be the biggest cloud provider. And then on the right here, we can see that this is the comparison from their latest LLM model that was released called Qwen 3 Max Thinking. And we can see that the models from Alibaba and the model from Alibaba is actually on par with performance. This is just a PhD level science type test that they gave these models, but the Chinese models are actually on par with some of the Western models and the Western LLMs. So just because China was cut off from the leading chips doesn't mean their model performance isn't similar to some of the Western models. We know that China has ample power and power capacity, so it's not as important for them to have the leading chips, but they can train these models on still some of the older chips to be as good as what we've seen coming out from the West. And then of course, this build out of the cloud business is quite expensive, and this shows the CapEx step up of the various Chinese hyperscalers and their projected CapEx for the next 2 years. Alibaba is committed to 350 billion renminbi over 3 years to build out their cloud business. So capital expenditure in these businesses have taken a material step up from the business models that we've seen in the past, and this shows that kind of journey. So in orange here, you've got the cash from operations, working capital in black, and then the CapEx number, and we can see this step up in CapEx in the last few quarters, and that's likely to continue. But the business does still remain very shareholder friendly. They've stepped up their buyback program quite aggressively until the end of 2024. They declared a maiden dividend in 2023. So they've actually returned quite a big amount of capital to shareholders at a run rate of about 10 billion. And the existing buyback program that's valid till the end of March 2027 still has $19 billion worth of capacity for buybacks. Next, looking at JD.com. So JD was originally founded in 1998. It was originally an offline retailer, and they launched their website in 2004, transitioning to a completely online e-commerce marketplace in China. The core difference between them and the others is their focus on logistics and their self-built fulfillment network, and again, their first-party retail model. So Pinduoduo, Alibaba focuses on third-party retail models. Alibaba is a first-party retail model. So you've got the core of the business being JD.com, but they've also got various other businesses within that retail segment. This is JD Health, which is an online pharmacy. You've got 7Fresh, which is the fresh produce business, 5-Star, which is the home appliance business, and then you've got the on-demand delivery and food delivery businesses sitting in that retail segment as well. And this is what typically greets you when you open the JD.com app. You can click through various stores to find products that you need, and then go into the various products to see the reviews of the products. There's typically banner ads that will try and pull you to certain products that's being advertised, and they're starting to monetize that more, giving third-party merchants on their platform the option to advertise and to pull consumers to their store. And then just quickly look at JD Logistics. So this was originally started in 2007 as an internal logistics department for JD.com, but it's been completely built out to be a standalone logistics business servicing external customers, and it's actually separately listed as well. JD Logistics actually started same-day delivery back in 2011 already, so they've been in this industry for quite a while. They've got a lot of expertise around logistics and supply chain efficiencies, and this is what gives them a competitive advantage in terms of managing their cost base to compete with the other platforms. And you can see that they do the full supply chain management from last mile, cold chain, cross-border logistics, warehouse management, the full supply chain. Then looking at JD's revenue split. I mentioned JD is predominantly a first-party retailer, and you can see this with the orange and the black line. So the orange line here is electronics and home appliances. That makes up about half of their top line. General merchandise is about another 30%, and then your advertising and commission, which is what you charge for your third-party sellers on your platform, and advertising is around 20% of the business. That's steadily been increasing over the last decade from 10 to 20, and this is also, again, a reminder, higher margin business. But the bulk of the business, 80%, is still from first-party products that they're selling, inventory on their balance sheet. And we can see how nicely the business has grown over time, but growth has stalled with a property bubble bursting from 2022, and you can see how the growth went from very high 20s type growth to mid-single digit growth. And then, of course, with the announcement of the government trading and stimulus programs, you can see how that came through and how that benefited JD's top line with consumers trading in products and then getting discounts on new products. On JD's profitability, business has again scaled very, very nicely, where the business was essentially break even more than a decade ago to earning 3 to 4% margins. But I mentioned that JD entered the food delivery space, and they've been very aggressive in this space. And you can see that even though gross margins have continued to slightly tick up, they've essentially invested all of their operating profit into selling and subsidies to take share in their food delivery. They've been very successful in this. They've gone from essentially zero market share to somewhere between 25 to 30% estimates. So they've been very aggressive, very successful. I think in time, we'll see whether the strategy works out. But for the time being, they've invested and they've taken quite a lot of share from Meituan. In terms of the cash generation, so the bars on the left in orange shows the free cash flow generation of the business compared to their net income in gray. And you can see that the business has traditionally been a very high cash converter, so essentially converting all of the cash, all of the income into cash, which is very positive. But lately, we've seen this investment into food delivery again starting to come through with the money they're investing there. And you can see our quarterly profits have trended down on the net income basis as they've invested. And then just in shareholder returns, again, they've taken a material step up in returning capital to shareholders. Over the past 2 years, they've returned more than $4 billion to shareholders in terms of share buybacks and dividends. And they've still got $2 billion remaining to August 2027 of authorized share buybacks. Maybe just to highlight here that the business is very cash flush because of that very high cash generation nature of the business. And you can see that at the moment, more than half of the market cap of the business is in net cash and investments. So then moving on to Pinduoduo. So Pinduoduo means together, more savings, more fun. Pinduoduo was originally established in 2015 and is a mobile-based e-commerce platform. And what makes their model different to the rest is that they focus on the team purchase model, and I'll unpack that in a bit. But they've also added a gamification experience to online shopping. And this is what typically greets you when you open the app. You've got various categories here at the top that you can go into if you're searching for products specifically. But it is really a recommendation-based shopping format. So you have recommendations based on your previous search history, or ads being placed by local suppliers to pop up in your recommendation. So this essentially allows users to discover products that they might not have known, and increases your purchase conversion rate over time. Pinduoduo was very successful because they started more in the rural areas, where consumers experienced online shopping for the first time. So the recommendation engine was very good at user conversion, and that's why they took so much share by focusing on that area that was historically more neglected by Alibaba and JD.com. And then in terms of the team purchase model that I mentioned, so when you visit the app and you click into a product, you're almost always greeted by two prices. You've got the individual price, and then you've also got the team purchase price. So what Pinduoduo did very well was to understand people's bargain mentality. So every product, you see a team purchase price that's lower than the individual price. And the way that you get the team purchase price is that you invite users and friends to buy products with you on their platform. So you'll send them links to the products on social media platforms. You'll form a team, and that then means that everyone gets the team price. So users are really encouraged to share product information with others, so that they can enjoy more attractive prices. But what this also means is that it generates very low cost organic traffic to Pinduoduo's platform and tracks users to their platforms. Your user acquisition cost is a lot less than we've seen from some of the other platforms. Dodo Grocery is another business that is an extension of the main app. So this is really this this app matches local supply with local demand. Every day at 11 p.m., whatever products is available on the platform resets. Users have until the next day to buy it, and then the day thereafter they'll pick up after 4 p.m. So so it's really what is in supply, and this helped the grocery business to kind of help match local supply from farmers with local demand and ensure there's less wastage. And then I mentioned the gamification of of their platform. So Pinduoduo introduced gamification within Dodo Orchard, as the previous Orchard app. That's the extension of the main app. And the above is an example of one of the games within the app. So users grow a tree within the app, and then once the virtual tree has grown and the fruits are ready to be harvested, you will actually win a prize and receive a real fruit being delivered to your house. And within this game, suppliers will pay to advertise. Users can watch videos of suppliers to earn more water to water their trees. So they really pull the user into to advertise to them, hopefully convert a sale. Suppliers will have banner ads within some of the apps, in some of the games to further to further to further promote their products. But this gamification to receive free products again drove user stickiness within the platform, but also organic user growth. They've got another app that's called Bargain, which is if you like a product and you share it with your friends, and enough of your friends like the product, you get a product for free. So again, a strategy to pull users to their platform and then increase the user stickiness through this gamification. And then, of course, you've got Temu, that Pinduoduo owns outside of China. And Temu really has two models. They're first of all trying to replicate the success they've had with Pinduoduo in China, but outside of China, they've got two models. You've got the semi-entrusted model, the one on the left, and you've got the fully entrusted model. And the major difference between the two is that with the semi-entrusted model, merchants essentially take care of their own logistics. So on the fully entrusted model, cross-border merchants need to send their goods to Pinduoduo, to their local warehouse, and then the warehouse sends it overseas with their service providers and logistics suppliers, and the platform takes essentially care of all of that. With the semi-entrusted model, merchants don't have to choose to use Temu's designated warehouses. They can decide to use their own logistic partners, and the way that suits them. So the semi-entrusted process, you can understand why the semi-entrusted model is more suitable for more established businesses that have already got agreements with other warehouses and logistic supply chains outside of China. But they offer both trusted and semi-entrusted to ship products outside of China. Of course, with the fully entrusted product and business model, it's much easier for smaller merchants to sell their products to the globe, where they're essentially just delivering it to Temu's warehouse, and then the platform takes care of all of the other stuff from pricing to the logistics and the selling and the returns and exchanges, as well as buyer reviews and so on. So looking at Pinduoduo's revenue and profitability, they disclose their revenue between two segments, being marketing services and transaction services. Marketing services is the Pinduoduo app and Dodo Orchard app within China. So they don't earn a take rate, or very, very small take rate on some of the stuff within China, but the predominant driver of top line within the Chinese e-commerce business is all advertising revenue. So merchants will pay for banner ads, links, and logos, and those ads and the price for the ads is determined in an online bidding system. Again, and then again, so any keywords, any banners, merchants will pay to advertise on the platform, and that's the way that they earn revenue in that local business. In terms of the transaction services business, this is the Temu business, and this is a take rate that they earn on all of the sales on Temu outside of China. And in terms of their revenue profitability, of course, being a 3P model, it's a very high margin business on a gross level, but the operating margins have also scaled very, very nicely from where they were loss-making just in 2020, start of 2021, to having very, very nice margins between 20 to 30% on an operating level at the moment. And then again, this business is an exceptional cash generator. The free cash flow of the business in orange is actually on average higher than the net income of the business because they run working capital negative. They don't have to own any inventory on their balance sheet, but they require merchants to pay deposits to them to ensure that the merchants follow the rules. So they're very strict on the rules in terms of what products can be listed on the platform, and after sales returns if there's something default with the product, and if the merchant doesn't follow the rules set by the platform, they'll use the deposit that the merchant paid to fix that. But it means that as the business grows, your business generates more cash than earnings. And you can see how that cash has steadily continuing to increase, where 40% of their market cap at the moment is in net cash and investments. And then lastly, quickly looking at Tencent. Tencent has various different sources of businesses, but they predominantly classified between value-added services, online advertising, and fintech. Within value-added services, around 21% of the 2024 earnings was domestic gaming, but the international gaming business has also grown very, very nicely. And the way that they monetize this is through the sale of virtual items, so skins and products that players buy within the games. Within social networks, they've got various different businesses. Again, mini games that has in-game purchases. You've got subscription businesses with Tencent Video and Tencent Music that's similar to a Netflix and a Spotify. Within that's about 18% of your top line. And then online advertising accounts, video accounts where users live stream and review products. You've also got mini games within that, and within the just online advertising within the bigger WeChat ecosystem. And then within their fintech business, they've got WeChat Pay and Tencent Cloud, and that's about a third of the top line. And just looking at how this has evolved over time, as I mentioned, the business was much more reliant on domestic gaming just a few years ago, but you can see how nicely the international segment has grown, and the business has diversified quite nicely over time. And just quickly on the games and how the business was started. So the first mobile game was Snake on Nokia in 1997, and Tencent was founded in 1998. And you can see how mobile has taken the bulk of the share in gaming at the moment. PC has kind of held its market share as consoles, but of course arcade has completely disappeared, and handheld has also decreased dramatically with the rise of mobile. So mobile games has taken the bulk of the share in online gaming, and is probably going to continue to grow to kind of give you a sense of the market that they're playing in. But then Tencent's also a global platform for game development, publishing, and operations. They own some studios with some brands that some of you would recognize, as Supercell, League of Legends, PUBG. But they've then also invested in external studios, and they've got partners with other external studios as well. So it's really a platform for game developers to also publish their games. And this positions them quite well for new games being developed by AI, both by their studios and by other studios, to kind of be that partner that publishes and manages the operations. Then just in terms of revenue and profitability, as I mentioned, the business has diversified quite nicely from being predominantly value-added services to have a better mix at the moment between the advertising business and the fintech business. And we can see here the drop in top line in 2022 with the government clampdown on gaming. But we've seen how nicely that's recovered and it's grown and is back to growth. And then profits have followed suit. So the business continues to grow their profits through operational leverage um, and the margins continuing to expand. Tencent again is a very strong free cash flow converter and free cash flow generator, which supports buybacks. The associates have also gone from break even to loss making to be quite material now in terms of being 12% of the operating profit. So nice other divestments from certain associates that was not working, but a lot of the associates going through the J curve and their businesses scaling that's contributing to Tencent's P&L. And then Tencent's been very shareholder friendly again. That the spin-off in 2021 of JD.com, where they were quite a big investor in. But you can see how they're continuing to return cash to shareholders through buybacks, 16 billion just in the last year. And then looking at the valuations, these businesses used to trade at quite high multiples just a few years ago, but then they've derated quite significantly since then. Something like a Pinduoduo and a JD.com still trades at sub 10 Ps, despite all that cash that they've got on the balance sheet at the moment. But we can see how excited the market got about Alibaba's prospects in cloud and AI, and their business has re-rated from a sub 10 P to close to a 24 at the moment. So with that, Karina, I'm happy to open it to any questions.
Brilliant. Thanks, Jacques. Maybe we can kick off with some questions that have started coming through. I will do a handful now just because we are quite tight on time. But yeah, let me kick off. So, how is the Chinese government encouraging companies to improve corporate governance and become more shareholder friendly?
So they've released their 9-point plan in 2024. The Chinese government realizes that the consumers' wealth creation mechanism through property has of course now decreased, and we've seen how the property bubble has burst, and property prices have deflated, and consumers have moved into savings, but the government is trying to move consumers more into the equity market. So in 2024, they released their 9-point plan, and it was a very specific set of plans to increase corporate governance and make the businesses more shareholder friendly. Some of them included specific instructions to delist zombie companies, to improve disclosure, to do more share buybacks and capital returns to shareholders. And we've seen that in the Alibaba and the JD.com numbers. But then it's also to stop raising capital for projects that's not going to earn its return on capital over time. So the government is trying to make the shareholder market more friendly to shareholders and ensure that the growth in the market or the growth in the economy translates into the market, and consumers can rely on the equity market as a wealth creation tool over time going forward to improve consumption.
Brilliant, thank you. And maybe just to follow on from that frame of thinking with the government, do you think the government will assist the property market in China?
They have to some extent with some of the debt that was on municipal balance sheets, but it's difficult to kind of predict what they're going to do going forward. We'll see how it unfolds, but for the time being, it's difficult to kind of predict how they will support the property market. Yeah, we'll have to see.
Yeah, cool. Thank you. And then maybe just to touch on some company specifics, how meaningful could AI be to Alibaba Cloud margins over the next 3 to 5 years, in your opinion?
So as I mentioned, at the moment, they're not that focused on the margin of the business. We'll have to see how that evolves over time and how they monetize it. For now, they're just trying to grow and take as much share as possible. But I would anticipate a pickup in margins in that business. I think 9% is probably too low to earn a decent return on capital unless there's some sort of step change in technology or efficiency of chips. But yeah, I think it'd be closer to some of the US hyperscalers, but for the time being, they won't get there, and that kind of also explains why the US hyperscalers need to trade at a premium to the Chinese AI and cloud providers.
Yeah, definitely. And then maybe last question from us today. What is your thinking around the food delivery war escalating further?
So we don't think it's going to escalate further. The government has kind of stepped in and said to the companies that they don't need to spend just for the sake of spending. Um, so so we think market shares will probably stabilize around these levels. I think margins will still be depressed at least over the next year to year and a half, because there is agreements in place with suppliers where they're not going to take commissions on products. So I think margins will probably be depressed, specifically in something like JD.com, at least for the next year to year and a half. But then we'll see how that kind of monetizes from there going forward. So our base case at the moment is not that it's going to escalate further, more stabilization, and then we'll see how it improves over a 2-year period.
Brilliant. Thank you so much, Jacques. To the audience, if we haven't gotten to your questions, please feel free to send us an email. We'll be happy to respond to you via email or set up a meeting. But with that, thank you so much for your time today, Jacques, and the audience for the interaction. We are looking forward to seeing everyone again next month for our next session. Thanks so much, everyone.
Thank you.
Bye.